Let's welcome on board Alok Agarwal as well and find out what he's making of the market right now. Alok, hi, good to have you on 80 now. Just wondering what sort of cues the market is going to work with in June, because pretty much all the good news seems to be priced in for now.
Yeah, hi, good afternoon. Pretty much so, but yeah, a lot of things have changed. We had a kind of a major correction in the first 2 months of this calendar year and a smart recovery in the last 3 months, despite some of the negative news, both globally and locally. But very interestingly, over the last 6 to 9 months, a lot of macro data have started turning positive with growth visibility improving and corporate earnings also the numbers are slightly ahead of estimates. So in all, certain things are improving, making the risk reward a little more attractive.
Right. Hi, Alok. Good afternoon. This is Shrishti. But help us with the sense that from here on, where do you see the markets headed, given your somewhat bullish stance on the markets, like some of the good pointers that you have been highlighting, and which sectors will actually participate in the anticipated rally, if at all?
The good part is, as we mentioned, a lot of the macro data have started improving first because towards the second half of last calendar year, a lot of macro growth numbers started showing, indicators started showing that there was a growth slowdown. But now, especially like the GST collection numbers being highest since November 23 in terms of year-on-year growth, the CPI inflation being at a multi-year low, the bond yields at a multi-year low, and very importantly, the way smartly the RBI has handled the liquidity portion from a negative 3 trillion at the beginning of this year to close to 2 trillion rupees positive. So a lot of things have gone positive. After muted quarters for last several quarters, now we have had double-digit earnings growth in Nifty 500 for this particular quarter, and with the broader market also participating nicely within that. So all in all, the numbers are looking attractive. Yes, in case the global volatility picks up and in case there is a trade of moving out of, say, some of the developed nations like US in favor of growing countries like India and China, so that could also lead to more fund flows coming India's way. That is an added benefit. But fundamentally, both macro and micro numbers are improving. Sector-wise, as you mentioned, the key sectors that are showing some growth and higher growth visibility, they include the likes of consumer discretionary. Within that, whether it is retail or some of the auto packs or select textiles as well. And in the healthcare, the hospitals are doing much, much better. And again, the select CDMO cramped players as well. Industrials is showing a lot of growth numbers and a good order book swelling as well, especially on the power and defense side. And lastly, on the financial side, the NBFCs look better placed, and the capital market plays right from exchanges to the wealth managers to the asset managers. They are showing some decent growth. So these are the areas where the growth numbers are coming up nicely. The visibility is improving, and that's where the focus area is.
We were just mapping NSE's valuation in the unlisted world, and it's jumped up nearly 45% alone in the month of May itself. But Alok, within the entire capital market space, where is it that you think there is still valuation comfort? Because it's really about the price that you want to pay for some of these names, right?
So the intriguing part about India is that something that's good quality and good growth visibility, it doesn't come cheap. So that's what the key dilemma for most of us as investors and fund managers is, that where you get the nice things, but they are never coming at a very, very reasonable prices. So one needs to see those names where the structural growth is better, not just the near term, and who has the right to win and is gaining market share. So those are the areas that are likely to sustain any kind of volatility as well and keep delivering on the earnings side. But the point well taken that rarely it's rare thing to find something which is value and good growth and good quality. So that combination is tough to find.
But Alok, nobody is really talking about the PSU pack. Yes, post-COVID, we have seen a lot of these PSU counters delivering great set of returns. But help us understand any pocket that is looking good to you right now within the PSU pack. Maybe it's banking or some other sector.
So let's dissect the PSU side more on the businesses front rather than the ownership front. So as you rightly pointed out, see, within the banking space, the combination of growth and quality is much better available in the larger private banks and some of the select large NBFCs. So that's where the view on those select large private banks and large NBFCs is much more positive as compared to the PSU banks. But when it comes to the other sectors, especially like the defense or to an extent some railways, these are dominated by the PSUs. So they are the ones who have the bulk of the orders and the execution and the lion's share of the profit pool of that sector. That's where in those sectors, the natural choice would be to have more of PSUs rather than the private sector. Eventually, as time passes by, there could be more and more private players, good private players who would come up the curve. That's where the exposure to those companies will go up. But instead of the ownership, it's better to see where the sector is dominated, who is having how much share of the profit pool, and where the growth visibility is much better.
Let's in fact pick up on that point. It's PSBs which are really the flavor of the day today. Look at SBI, that's seeing a sharp surge. It's more than 2% off the lows. The entire banking pack, 3.5% uptake. BOB is higher by 3%. Canara Bank is sitting with very hefty gains for itself. And then Union Bank, which is also scaling higher than about almost 4% or so. Alok, for the longest time, everyone's been bullish on banks, and now that strength seems to be trickling into the PSBs as well in particular. Do you think it's time that they will play catch up now and one perhaps can increase weight there?
Yeah, the risk reward seems attractive out there. But again, if I look at the banks, the key numbers that I would track, they include the credit growth, the deposit growth, the potential for margin expansion, and lastly, the credit cost. All these four numbers are found to be little lagging as of now. I would really await some deposit growth to pick up, which would enable the banks to have a higher credit growth. The environment is pretty okay for the credit cost side, but as the thing goes, we are in a cycle which is likely to see a rate cut rather than a rate hike, and a falling rate cycle is more favorable to the NBFCs as compared to the banks. So my pecking order in terms of the lenders would be first the select NBFCs, followed by the select good quality large private banks, and then the PSU banks. It is possible that all three of them deliver, but the hierarchy of choice would be in this order.
All right, so that's the take coming in on some of these PSU counters, and especially the banking counters. But Alok, soon we will see the deadline for the tariff also getting over. Yes, of course, the nations are gathering the pace to go ahead and make some negotiations there. But amidst this, we have seen all these export-related sectors getting hammered, and along with that, some of these domestic sectors were getting interest. Once this dust settles in, Alok, do you believe that there stands a chance wherein some of the export-related plays can once again get back into flavor? Any sector that you wish to highlight, or what's your take? How will the markets react to any negotiations, especially the Indian markets?
So as you pointed out, the export-oriented sectors, especially the ones which have exposure to the US, the large part actually includes from the IT and the pharma side. And especially on the IT side, it is not just, there's no rule as such which is affecting them directly. But in case there's any slowdown or any kind of spending curbs on the US companies, that would affect the overall growth numbers of the IT companies. And more importantly, how the AI thing is going to play out for them in terms of margins is something that we need to really watch out. There have been voices on both sides. But yes, in terms of the overall earnings growth projections, visibility vis-a-vis the valuations, the risk reward doesn't look too attractive, at least for the larger names. There are select mid-cap names which are in some niche areas which are growing at a good pace. They could still deliver much better numbers. Similarly, on the pharma side, we have been hearing so many noises around sometimes on the price side, sometimes on the curbs on certain allocations. It's better to when the visibility is not there as much. I wouldn't want to really venture out and take a hard guess and venture overweight. This is at a time when some of the domestic companies on the healthcare side, especially the hospitals, are doing so well. a good amount of operating leverage is likely to play out for them with their hospital bed capacities rising, and they're doing pretty well on the operating efficiency side as well. So the export-oriented names, in short, IT and the export-oriented pharma, I would be a little underweight at these times.
Right, okay, that's the texture and flavor of what's happening in the markets right now. We've got Arpit as well joining in to talk about what he's making of the charts right now. Arpit, hi, afternoon. What's been your sense? It's been quite a range day, but where do you think we're headed next?
Very good afternoon to all. So first talk about the Nifty and Bank Nifty. So this series relatively Nifty has been trading in a very narrow range from last almost 10 to 15 sessions. But if you look at the weekly chart, it is consolidating between 24,650 to 25,050. So overall, but the good part is that as soon as we see some dip towards the lower levels, we see recovery from the lower levels. At the same time, 25,050 is the hurdle zone. So overall, our stance would be positive till Nifty holds above 24,650 levels. But at the same time, 25,050, 25,200 would be the hurdle levels. We're talking about Bank Nifty. So Bank Nifty, the entire May series has been consolidating between 1,500 points range, whereas on the weekly scale, 55,000 is the immediate major support. And today also we have seen good momentum in PSU Bank, which is helping the Bank Nifty. So relatively as compared to Nifty to Bank Nifty is relatively likely to outperform. And I think a closing above 55,555 Bank Nifty can see move towards 56,250, 56,500 levels. So overall, a bias would be slightly positive on Bank Nifty as compared to Nifty.
Okay, well, India is one of the most competitive markets. That's the word coming in from none other than the Interglobe Aviation CEO, Peter Elbers. He also sees massive opportunity in India with very ambitious travelers now.
India has been on a gradual trajectory of further internationalization and further growth. And, you know, we feel as the nation is spreading its wings, it's also Indigo spreading its wings. I mean, if you can operate in what I consider as the world's most competitive market, being India, I think we have a good starting point to start moving international. If home has an incredible, ambitious traveling public, I think the opportunity really is out there to build on that international network and international opportunities. And 65% of the world population is living within a 5 to 6 hour range from India itself. So the opportunity that provides for us is really the driver, not whether we have a bit more or a bit less market share. The opportunity which is out there, and I think Indigo is very well placed to make use and actually to reap the fruits of that opportunity. Indigo is very well placed here. Indigo has the world's largest order book, and we have over 900 aircraft on order. With that large order book, we are in the position to get one new plane each and every week coming into our fleet. Overall, globally, we see actually an improvement in the supply chain, and with that, a reduction for us in terms of number of planes on the ground. And with that, we're very confident that we can continue our growth trajectory going forward.
Right. Alok, wanted to get your opinion in. I mean, of course, you know, within the entire aviation space, there is only one choice, and that continues to be Interglobe Aviation. But if one has to really broaden one's horizon, look at the entire tourism and hospitality industry, what's the best way to play that? Is it going to be via some of the aggregators, still very small in terms of market cap? Is it going to be via hotels? Or would you say aviation gets the benefit of it all?
So I think the better one would be the places where there are choices for operating efficiency and some degree of pricing power. So that is actually coming in the aviation side and some of the hotels as well. So some of the large ones as well as the mid ones as well. But on the aggregators side, I'd see some kind of margin squeeze happening there. So I would really prefer the aviation side and the hotel side to play the tourism side. And the growth numbers are pretty good. So the view is positive on the tourism side.
Okay. Alok, so good having you on the show. We'll let you go on that note. Good speaking with you as always.
Sure.
If you like this video, then like, share and subscribe to ET Now.